Can you believe it's June 2014 already? With only 30 June weeks away, we thought it's timely to bring you some of our WMS tax preparation tips for 2014. I'm going to call these Hazy's Top 10 Tax Tips for 2014. We're going to bring this to you in a two-part series, tips 1 to 5. Today you'll be viewing, and tips 6 to 10 in a week or two's time. Now these tips are in no particular order. I love all of them, and trying to rank them in order of 1 to 10 would be like trying to choose my favourite of my 3 children. Well, that's impossible to do. Incidentally, I do have a favourite, but I'm not going to tell anybody that right at this point in time. Okay, tip number 1 is maximising your capital gains tax benefits, or in other words, trying to minimise your capital gains tax. You may have already made a capital gain this financial year. So ordinarily tax will be due on that on lodgement of your tax return. So our advice to you would be to look at any investments that are potentially running at a loss at the moment, and look at selling those investments prior to 30 June. The loss that's accrued will then be offset against capital gains you've already made, helping to reduce your capital gains tax liability. Of course, the important note there is for capital gains tax purposes, the taxing point is the contract date and not settlement date. So if you're looking at selling some real estate, you may look to defer the signing of that contract until after 30 June in order to push any potential capital gains tax liability into the following financial year. Okay, tip number 2 is the writing off of bad debts. This is an annual favourite for us. It's an annual favourite for the tax office as well. What you need to do here is actually review your trade debtors, and for any debts that have gone bad, so for any customers that have not paid, those amounts are not recoverable, you need to physically go into your accounting system and write off those debts. Ordinarily you'll be required to provide or possibly provide evidentiary documents to confirm that you have written those debts off. That may include legal correspondence. You may have engaged lawyers to assist in trying to recover those debts, or potentially directors' minutes or resolutions actually writing off each individual bad debt. But critical to that, it must happen on or before 30 June. After 30 June is too late. Tip number 3 is the payment of franked dividends. If your company's paid franked dividends during the year, now is probably the time to go back and look at your franking account to ensure there are sufficient franking credits in your accounts. That test is a 30 June test, so if your franking account has a debit balance as at 30 June, the company could potentially be up for franking deficits tax. So now's an opportune time for you to go and look at that franking account balance to ensure sufficient credits are available for the payment of franked dividends. Tip number 4 is the trust distribution resolutions. So the ATO have taken a different approach over the last couple of years with respect to trustee resolutions regarding the distribution of income from trusts. So if you're trading or you're investing through a discretionary trust, or you may have heard the term family trust, it's important that those trustee resolutions regarding the distribution of income are made on or before 30th of June each year. Where those resolutions are not in place by 30 June, there is the potential for the ATO to assess the trustees on the income of the trust at the top marginal rate. So the key from this point is to make sure those resolutions are made and on file on or before 30 June. So the last tip for today's session, part 1 of our top 10 tax tips, is tip number 5, and that is the value of your trading stock on hand as at 30 June. We recommend you review the value of your trading stock on hand in the process of doing your annual stock take. We're looking for obsolete items, items that have been destroyed, and even items that are just slow moving from the shelf. The impact of this is where the value of that stock is actually less than what it cost you. That has the effect of lowering your taxable income, which in simple terms means you'll pay less tax for the 2014 year. So have a look at your stock that's sitting on the shelf. It's been there for a while. All those empty cartons out the back, those are the sorts of things we're looking for to come up with a value for that stock as at 30 June. So that concludes part 1 of our top 10 tax tips. You've heard tips 1 to 5. We will resume with a new video for you shortly, detailing tips 6 to 10. But in the meantime, if you've got any concerns or you're not sure about any of those items, the tips 1 to 5, then I recommend you certainly do what I do, and that is talk to your accountant. And here at WMS, obviously, we have a few, so get in touch.